with this week's edition of Freedom Flash, some timely insights about today's market. Welcome, everybody. Again, this is Peter Culver and Kyle Cain from Freedom Family Office with this week's edition of Freedom Flash, our commentary on the markets at the current time. So today we're going to talk about the Fed and interest rates. We're speaking to you today on Friday, March 18th. And on Wednesday, just 2 days ago, Kyle, the Fed announced it was increasing interest rates. So let's share with our audience our thoughts about what actually happened, what the Fed said about its forward-going posture is, and what's the significance of the rise in interest rates, both for markets and for the economy.
Yeah, so as you said, on Wednesday, the Fed had their regular quarterly meeting, and they decided to go ahead and raise interest rates. I think the Fed chair, Jerome Powell, did a very good job sort of telegraphing ever since last year that this was coming. So the markets didn't come as a shock. However, the difference is that just about a month ago, the markets were actually pricing in about a 50 basis point rate hike. This was before the Russia-Ukraine situation arose. So in this meeting, the Fed decided to go ahead and raise interest rates by 25 basis points. What that means is just the federal funds rate moved up from 0 to 0.25%. They then indicated that they think that over the course of this year, there will be an additional 6 interest rate hikes. So 7 total hikes throughout the year. In addition to that, another important note is that if you remember back in November, the Fed started to taper their quantitative easing, their monthly bond purchases. They indicated that this year, all those additional bond purchases will have been tapered off, and then they're going to actually commence to start to reduce their nearly $9 trillion balance sheet. And this could happen as early as May. So they said, consider that like an 8 rate hike for this year. So what they specifically said is they're hoping to target around a 1.9% rate by year end.
I guess that's the first part of our news today. That's what happened and what they've telegraphed. So let's start with markets. How has the market reacted to that? And what would you say in general is the significance of what seems to be a pretty firm commitment now by the Fed to raise rates to particularly the stock market?
Like I said, I think, Jerome Powell did a good job telegraphing it, and it wasn't too long ago that the markets were pricing in an even higher interest rate hike. So the markets have actually taken this news very well. And the past few days, the markets have been up, substantially. Interest rates have, risen, considerably in the past month, but it hasn't deterred any outlook on the stock market. Immediately when the meeting minutes were released, the market dropped. But then, Jerome Powell got in the conference. Jerome Powell started to have his conference, and then Jerome Powell, began his commentary and tried to reassure that he felt that the economy was strong enough, despite what's happening in Russia and Ukraine, to withstand these interest rate hikes. He indicated that we're still far away from what they consider the neutral rate, right? The neutral rate is where it goes from easy monetary policy to a tightening. So he doesn't see that this, what's happening in Ukraine and these hikes going to push us into a recession anytime soon. Historically speaking, rising, when the Fed decides to raise rates, that's not a bad thing for the markets either. I know a lot of investors are concerned that, this could be the start of, what's going to push us into a recession. And, historically speaking, after the first rate hike, the markets are up a year later. The reason being is because it's usually indicative that we're still in a mid-cycle phase of the economy. And like we said, the Fed neutral rate, we're still far away from tightening of the monetary policy. We still have very easy monetary policy and are going to have some for quite some time. Even more specifically, historically, it takes about, over 3 years from the time that there's a first rate hike before the economy has historically gone into a recession. And over those 3 years, the stock markets have done, really well. So we would say it's definitely too early to call, this the end of this economic cycle, and that you don't want to miss out on the potential upside over the next few years. Interesting, what's more important to look at is how interest rates move both on the short end and in the long end, right? So the Fed moves the Fed funds rate, but how does that impact the 10-year treasury? How does that impact the shorter term 3 months and 2 years? Historically speaking, when you need to start to be concerned a little bit more is when the 2-10 becomes inverted, meaning that the 2-year bond yield goes above the 10-year. That means that the markets are pricing in, less future growth. And historically, when that happens, that's when, more often than not, the markets move into maybe a self-fulfilling prophecy and move into that recession earlier. So that's a close thing that we'll continue to watch, but we're still, ways away from that, and don't think that that's an immediate concern for investors.
So I think the summary would be the Fed raised rates 25 basis points. It was actually less than was anticipated. They've targeted a pretty significant series of interest rate rises throughout the rest of the next 12-month period. But even with all of those interest rate rises, rates would still be well below the Fed's neutral target. And probably because of those facts, the markets reacted very well. The rate hike itself shouldn't have a significant impact on the economy. So I think as far as investors are concerned, we wouldn't see the rate rise as something negative from the standpoint of participation in the stock market. That's a Freedom Flash for Friday, March 18th. Look forward to being back with you next week with some more timely news about the markets and the economy. As always, Kyle, thanks very much for your insights.
Thank you.